From the morning reading, Dow Jones Industrial Average moves higher. 4 of 9 sectors moved higher on Wednesday. XLB, XLI, and XLF were the strongest sectors, while XLP was the weakest sector. Oil fell $1.06 to close at $31.69. Breadth strengthened as advancers led decliners 1.76 to 1 on the New York Stock Exchange, and decliners led 1.42 to 1 on the NASDAQ. Active investment managers are not only underexposed to stocks, they're confident about it. This week, the average manager was only 22% exposed to stocks, the lowest level since September. Even more notably, there was a heavy dose of groupthink among the managers, as the variability among their responses was amongst the lowest since 2006. Investors yanked money out of mutual funds and ETFs again this week. That makes 10 weeks of outflow in the past 12 weeks. The total outflow over those 12 weeks is nearly the most since 2003. Though as a percentage of total assets, it has been eclipsed a couple times. Traders moved more than $750 million into the main gold fund, GLD, over the past week. Inflows are a good thing as long as they don't become extreme. This weekly flow was the second largest since 2012, and it hasn't taken much of an inflow in the past few years before sellers return. Short-term sentiment on gold and miners is getting stretched, and if it can shake this off and hold steady, then it'll be one of the first such signs of longer-term buying interest in more than 3 years. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:24 a.m. Central Time, and I'm recording this in preparation for the market day of February the 5th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And pretty much scratch, which is not a surprise, the night before a monthly employment report. This is often the case where the markets will go flat until that very important report comes out. Remember, one of the two biggest things that the Fed watches in making their own assessments about interest rates and all is the employment situation and inflation. So there's just a handful of reports that really go to the very heart of that decision, and this report is one of those. So the S&P futures is essentially just above scratch. Russell futures just below scratch, NASDAQ just above scratch, as is the Dow. Crude oil is up about 1%, Euro down just below scratch. Bonds are marginally up about 0.2%, and gold is about the same. In overseas action, China is down about 0.2%, Hong Kong going the other direction, up almost 0.2%. Japan down 1.3%. Germany down just below scratch, and United Kingdom up just above scratch. In terms of macroeconomics reports for today, of course, there is that all-important monthly employment report and all the related information that comes out with that. That will come out pre-market, and that, along with trade balance, will be just about it. There isn't anything of any significance that comes out during the cash market today. In terms of current volatility conditions, we're pretty much in a range. Short-term VIX is just below a 22. Skew is in a non-warning status. IV percentiles on the S&P is at a 32, the Russell 42, the NASDAQ a 41, and the Dow a 39. There were no standard deviation moves put in on any of the markets yesterday, so we've had back-to-back days of relatively close-to-close calm in that matter. And in fact, when we go to the charts, you're going to see that yesterday's action was pretty much an inside day. We did have some wicks on both sides, but small body, so you end up with kind of a spinning top, something of indecision, just kind of inside action. We are very, very neutral when you look across a whole bunch of different metrics right now. And this is certainly being reflected as we look at the chart and the current price action. It's just about as neutral as it gets. In terms of the others, let's take a look at the NASDAQ. Very much the same kind of a pattern. The Dow, a little bit more bullish than perhaps the others, but still within this kind of neutral range. And you notice here this pattern. You could draw this a couple different ways, and this is one of the things that we're having to watch to see what breaks down. Obviously, coming into the pattern, you were bearish, quite bearish. Then we had the reversal pattern, which confirmed with the diagonal resistance breakout. Then this went into a consolidation pattern and then legged up. And we could argue in the short term that we have a higher high and higher low, and that this is kind of a reversal pattern. A couple alternates here, depending on how you draw this. You could have a channel or you could have a wedge, and especially if you look at the different time frames, a wedge certainly seems to be playing out in some of these patterns. If indeed it is a wedge, or this is a bear flag pattern, then we would expect a continuation of the prior trend, and that's a bearish trend. If that plays out, especially you look at the S&P 500, if that plays out, you could have a very, very significant down leg that could take us down well below 1800, because you use the measurement of what happened going into that pattern, and then you use that as your measuring tool as to where this would potentially go if it were to break down. Now, none of those things have to happen, but it's certainly part of the possibilities that are sitting out there, and you have to consider that. And you think about what we read from the morning reading as those active investment managers, being very, very low in terms of their exposure to equities right now, which on the flip side means they're holding a lot of cash or a lot of bonds, or perhaps other safe haven status, even maybe some gold, that kind of thing. So why are they doing that? Well, they're looking at these same kinds of things, and they're seeing an overall pattern which seems to be deteriorating and has significant risk involved. Now, none of those things have happened yet, and until we break through, especially below this 1866 area, get a close, not just a wick, but a close down below this area. This 1800 area probably doesn't even come into significant probabilities. But if we do find, and today could be that kind of a day, if we get a poor employment report, that could be the kind of trigger. Now, frankly, I would be surprised if the employment report were that poor that it would be the trigger event, because one of the strongest parts of all the economic reports that have been coming out for months now has been the employment report. So unlikely that it's the trigger. It's probably going to be something else. So probably not today that we see this deterioration, but whatever the event or the timing, and whether it's next week or 2 weeks from now, at some point, it's very likely that we're going to challenge this level again, and we're going to see where that goes. Now, it challenged it just a couple days ago and was repudiated in a big way by the bulls. We talked about how this pattern formed on an intraday basis and how much energy and momentum came right as we tick-tock the bottom here. It just reversed on a dime, and it was obvious if you were watching your charts on an intraday basis at that point. So that's certainly a formidable support area. It will probably take some pretty significant energy and momentum to take it through that area. Let's take a look at volatility. Volatility has been also in something of a neutral stance, though in a relatively high range. Remember, we kind of think of bull markets as being in this below 18 down to about 12 area, and we're much elevated over that. So this is, in fact, it's been kind of toying with coming back into a squeeze pattern. At the same time, it's an elevated range, so there is some consolidation here, some compression here, and that could also be resolved by the market breaking out of its own neutral short-term stance. In bonds have been very strong, and this certainly is one of the signs that there is great concern in the overall market. And you say, well, where's all this money that these active investment managers are putting their clients' funds? Well, this would seem to be a pretty obvious answer, in that they're going into the safety and security of the long bond. And while there was an expectation and concern that there would be an unwinding of interest rates, if you look at the expectation of that interest rate, you look at the expectation that's being factored into that long bond interest rate being changed, it just isn't reflected as you look out to these future time frames. And you basically take 1 minus this number, and that's the expected kind of Fed interest rate with a small variable for time and volatility put in there. And it's not being priced in. There's a very, very low probability that what the Fed has told us, and that we're going to get quarter point increases on a quarterly basis 4 times this year, that is not reflected in the 30-day Fed Fund futures, which is the kind of go-to place to see just what the traders think of the future in interest rates. So kind of pretty interesting things going on there. And then let's see if there's anything else we want to take a look at. I think that's probably enough on that. Let's go ahead and go to our daily report. And we're still looking at this phase 1. We had come out of this for a day to phase 2, but then retrograded back to phase 1. And there's a number of other things here that still continue to be this market in transition and relatively ugly in terms of if you are a bull. We do have a confirmed uptrend. This has been here for several days now from IBD, but accumulation distribution scores on the S&P and the NASDAQ are still a pretty woeful D+. GMI index has been stuck in sell signal since December the 10th without fail, and that author remains in cash. The stock charts decision point scoreboards, we did have them some improvements in that these 4 green arrows came in a few days ago, but we remain, other than that, in all time frames and all markets, very, very decidedly neutral at best. In terms of the intermediate term market posture, we are bullish, and these continue to climb, and indeed they're well up over 20 now. They've just slowly but surely ebbed, even sometimes just a tenth of a point or a couple tenths of a point up. At times it was so flat we really wanted to call it neutral. And when we went and flip-flopped to bearish and then back to neutral or bullish in a mechanical signal, we didn't really move far enough to really say that it was a valid change in signal, and that it was really just neutral. You really like to see that move by more than 2.0 before you kind of call a flip-flop, a new valid signal. In terms of position sizing, we're still at the 100% and the 50 to 75% on the 2 systems there. Hedge warning status remains threshold level 1, somewhat elevated. There is the potential, as we look at these chart patterns and other signs of the market, that this could elevate and we could see a deterioration of conditions. But until we do see that, then we just simply go with a moderately increased hedge status, but not one that is too bearish or too bullish, because this could very easily just simply break out the upside, and you could see this pattern on the S&P, for example, as higher highs and higher lows, and we continue to slowly break up. So it is not a sure thing that this is going to break down. Indeed, if you take the that position from the morning reading about the active investment managers, a lot of times when a lot of people are on one side of the market, they're the ones that get hurt. And this market could very easily break up and really, really surprise a lot of people out there. If you look at the particulars on some of the individual warnings, we still have market in decline and sharp increase warnings. Still had that VIX futures up over 18. The week out expected move in the SPX is still quite elevated. We still have on the New York Stock Exchange, new highs, new lows. Wasn't actually quite the threshold of a warning status at 300, but certainly was approaching that. So a lot more new lows yesterday, especially for a candle that ended up being a spinning top. There was a lot more new lows than new highs put in. So breadth continues to be something of a concern, with very few companies actually participating and being the ones of strength. Key intermarket risk aversion indicators still at 3 of the 5 at risk off. You show on also the sentiment indicator, the short-term risk is up to a 7 now, so some increasing risk being observed there in recent trading sessions. The fear and greed index is now at 25. That's the same thing as it was yesterday, and a little bit lower, or I should say higher, and higher being better than it was a week ago. In terms of special opinions, no change in these special opinions. Continue to have conditions that are borderline acceptable for the initiation of new positions for novice traders with covered calls and put selling. And then there's a number of defensive strategies there that we continue to talk about in that situation. In terms of option income strategies, that VIX is still outside the acceptable window to initiate new positions for novice traders, though more aggressive traders who are well prepared and experienced in taking those adjustments with larger delta and vega moves may find that the increased premiums that are available right now are quite attractive. In terms of sector specific, you see utilities continue to be the one that holds up the best, with some signs of late coming in from materials, industrials, and telecom. Telecom also being one of those defensive areas noted often for pretty good dividend streams. But we have seen some interesting mix coming in from materials and industrials. If you're going to have a market kind of find its footing, you should see it in places like materials and industrial. So that was kind of interesting yesterday. We've had a bit of a move with the dollar of late, and that affects the price of commodities. Much of this move with gold of late may very well just be a reflection in the change with the dollar in other currency relationships. We'll see if that actually plays out. We've had so many false breakouts to the bull side on gold in recent months. It's hard to take it for real until we get something that has some energy, momentum, and real breakout strength to it. But there's a lot of chatter that gold may be finally breaking out, so it's something to keep on your watch list. In terms of percent change, you see indeed materials, industrials were the heroes yesterday, and on the 5-day basis, this is significant. A 9% move in materials and almost 4% move in industrials at the same time that the rest of the market is seemingly really struggling is of note. So that may also be something for you to explore with your watch list development. Is something developing there that you might want to set up and initiate some toe in the water kind of positions and start exposing yourself to a little bit more bullish exposure in those areas. Okay, so I think that's probably enough for today. As always, if you'd like to get yourself on the email system, there's a couple different ways outlined here. Just go to this website, roll down just a little bit, find this button, hit the button, put your name, address. It's actually just your name and your email address, and then that'll get you set up. You'll also get a hyperlink to get the ebook, The Portfolio Strategy. You can also send a text through your smartphone to Falcon Global, all one word, to the number indicated here, and that will also do the same thing. I'll scroll through the rest of this. If you see something of interest, just hit the pause button, and you can spend a little bit more time on that. Disclaimers as always, hit the pause button if you need more time to review, and you see the hyperlink at the bottom for the full set of disclosures. We'll see you back here on Monday morning with the Falcon Global Market Preview. Good trading.